Hi, traders. There's something to be said for these markets. Sometimes they can be quiet, but every month, every couple of months, we get some decent data, some decent events. It always swings around, lots of volatility to come, and we've got such a week. So I will welcome K-Man and Stilius and you guys into it. Morning,
Hello, hello.
How are we all doing? Good weekend?
Very nice. You don't want to see the weather forecast for Athens for the next few days. You
Right,
really
where's
don't.
the ban button on this thing? Steve, I want to ban Stell forever. Don't start that, Chestnut. We've
How
got
was
cold
your
weather coming
weekend?
our way.
Everything all right?
Yeah, all good, all good. Went to a comedy show last night up
Oh,
in London.
nice.
Yeah,
That's the one thing I miss. I used to go to the comedy store in well in the center, right? And I used to go to improvisation nights. Yeah, I'm a huge fan of Whose Line Is It Anyway? I don't know if you ever watched that
yeah,
one.
yeah,
And I would wait when people like Paul Merton and Josie Lawrence were live, and I would go there. And it's just one of the things I really miss about London.
yeah. Well, I put this comedian at the Hammersmith Apollo a couple of weeks ago,
Oh, nice. Which one?
and then the bugger he booked in the BIC Centre in Bournemouth here. So I
Ah,
could have saved myself a trip going all the way up there.
yeah.
But that's the way it is. How about you, Kay? You all right?
Yeah, all good, guys. Yeah, decent weekend. Ready to go again.
Yeah, recharge the batteries and let's get going. We're going to have a look at what's coming up this week because there is quite a bit, but we'll start with some of the headlines and bits and pieces from last week over the weekend. UK public inflation expectations for the next 5 to 10 years rose to 3.8% in Feb versus 3.5% previously. The next 12 months jumped to 5.6% from 5.4%. This was a City YouGov survey that they run monthly. That'll be watched by the Bank of England for those inflation expectations before they decide whether they're going to cut rates, hold rates, raise rates, or do a little dance in the middle. Who knows? But higher inflation expectations coming in there. As we know from the UK, inflation isn't coming down as fast as seen elsewhere. Things like grocery inflation is still hitting record levels. So still a lot of inflation to come through in the pipe in the UK. Over to the ECB, and Archdove Centeno said the ECB targets headline inflation, not core inflation, which is a bit strange because all we've heard recently from a lot of EC members is that the core number is the one that's going to stay perhaps high and sticky, and the one they're going to fight with policy. But as I say, he's a dove. Also said ECB should not rush to conclusions very fast, and the downside surprise on inflation data, or sorry, there was a downside surprise on inflation data versus the December forecast. Maybe you need to check out the numbers that came from France, Germany, and Spain last week. He says the ECB should heed lower inflation forecasts in March. So dovish comments for him as per usual. ECB's Lane was out this morning with a speech. The choice line from that saying that current information suggests more hiking after March. Over to the Riksbank, and Handelsbanken is gone hawkish on their view for the Riksbank. They say they're going to hike the rate to 4.25% now. They see a 75 pip hike in April and 50 in June. That was from their prior forecast of a 50 pip hike in April and nothing in June. So they've gone up 25 and added a 50 in for good measure as well. So a big hawkish turn there. BOC is this week as well, and all 32 economists spoken to by Reuters see them holding the rate at 4.5% on Wednesday. Some data out last week, and today we know what the ISM services are. Came in slightly down 55.1 versus 55.2 expected. Prices paid was a little off. Employment was strong, went up to 54 versus 50 prior. and new orders was slightly stronger as well. So ISM data holding up over there. This morning we had some construction data out from Europe. As you can see there, all stand in contraction, though there are a few improvements, except for France, which went backwards. So still in contraction there. The UK number, a nice healthy jump following services going from contraction well into expansion in February. Could be a little bit of new year pickup on that. We shall wait and see. Retail sales from the Eurozone not looking too hot, worse than expected. Minus 2.3% versus minus 1.8% prior year on year. On the month, 0.3%, so up, but a miss of what was expected at 1%. We have seen strong numbers in the Eurozone country reports. So this is the pan-European number, but again showing a positive January all round, much as we've seen in the rest of the globe. Going back to the US and the Fed's Collins said further rate hikes are still needed to cool prices. Inflation remains too high and there's still more work left to do. Barkin said policymakers have forecast additional hikes and expect no rate cuts this year. If inflation persists, we can raise rates further. Fed's Daily over the weekend says more rate hikes likely needed to cool inflation. There's been a few headlines over the weekend, geopolitical stuff really. A senior EU official says that the US and EU are working towards an agreement in principle on a free trade agreement-like status. So not a full free trade agreement, something that's like a free trade agreement. See what that turns up as. And the US apparently wants to revive UK trade talks after the Northern Ireland Brexit deal was announced. So that had sort of hit a bit of a back burner, a trade deal between the UK and the US, but the FT report that may be back on the burner. Russia apparently plans to mothball the damaged Nord Stream gas pipelines. This was the stuff, I believe, that the Canadians were fixing all the parts, and we had all that mess shipping them back and forth and getting the paperwork. So apparently they're going to tin that off, the Russians. An EU official was also out saying it would be an absolute red line if China provided weapons to Russia and would respond with sanctions. The WSJ report that China's military spending growth could accelerate to 7.2% this year. Again, this is all coming into the mix. China, Taiwan governor said that they need to be on high alert for a quick incursion possibly coming. So more headlines on the Russia, China, US stuff coming out there. That's all I've got this morning. To be honest with you, a bit of a quiet weekend for once. Unless you boys have anything you want to throw in?
Nah, not really.
You got anything, mate?
No, not specific. I think you covered most of it. But about the US and EU FTA, is it not like just concerning some form of batteries or energies or energy? Perhaps I misread it. What they really want to do, but I thought it was only for a part of trade or so. No.
Yeah, I'm not sure.
I need to find it back because I'm whoops, sorry. I was only half looking at all the news over the weekend.
Yeah, there's
the biggest thing though was the start of the Chinese 2 sessions, where China is very conservative in their aim for economic growth. So where the market was expecting them to target 5.5–6%, they only put it at 5%. Attached to that was that they are planning less than expected infrastructure injections. So that's what's been weighing on the Chinese yuan, and per correlation on stuff like Aussie and Kiwi and Rand as well this morning. So that was the what really caught my eye in the weekend news. And I must say it's a like a lot of things, and I understand the market reaction on less positivity, less infrastructure plans and stuff. But I'm a little I don't know, in doubt about the viability of this move, as if you put your growth targets a bit lower. I understand the initial move, but then it's probably also easier to beat them, right? When the data will be coming out.
Yeah, I've seen. I think it was a Bloomberg piece. I think probably from analysts saying that the 5% target, although modest, would potentially reduce the need for any further easing in China. There is going to be a new central bank governor at the PBOC on March the 12th, I believe. But he'll just be following the party line, whatever they decide to set anyway.
Well, perhaps
but
that's even those were the rumors already last week that Xi was going to try and take even more control about Chinese finances. So that's a bit of a logic follow-up, and could have been also one of the reasons why the Chinese yuan is a bit under pressure here.
Yeah, exactly. Well, let's have a look at what's coming this week, because it is a pretty significant week. Let's pop that up for you there. So starting today, not too busy, ease us in nicely, just factory orders coming out. Tonight we've got the RBA, the first of the central bank runs coming. Tomorrow Powell has his first appearance before one of the committees for his Humphrey Hawkins or biannual appearance to explain monetary policy. Those of you who are in a chat room would know, in the newsroom, his monetary policy report is out. That was released on Friday. That's going to form pretty much the basis of his testimony, which, if I recall, we usually get maybe about 1 o'clock GMT. We'll get his actual testimony headlines released ahead of when he actually pops up in this committee to read his testimony. So we'll see if there's any choice lines in there regarding the future of monetary policy, or whether he just sticks to the script, which he can largely be just a repeat of the last FOMC statement and whatnot. So that we'll get tomorrow anyway, one way or another. He then pops up in the second committee hearing on Wednesday. That's usually a rinse and repeat. We usually know what he's dropped. If he's dropped any bombs, we'll know that likely on Tuesday, unless he gets asked a particular question that he wasn't asked on the first one. Some retail sales numbers in Europe on Wednesday, final GDP number from the Eurozone. Then we start with the jobs data with the ADP coming out. Then it's the Bank of Canada announcement at 3 o'clock, more jobs data from the JOLTS. Japanese GDP coming in on Wednesday as well, some updated numbers there. China CPI coming in early hours of Thursday morning. That's one just to keep half an eye on. Now we're getting a bit of recovery in China. If that picks up, we could see some inflation pressures potentially building following what's happening in the rest of the world. China's central bank has their target at 3%. So we just need to see if they catch the same cold as the rest of the world in higher inflation. Then we get some PPI data out of Japan later on there, and some household spending. Also, just for Thursday, keep an eye on that Challenger job cuts report. It was quite a big one last month, reflecting some of these big tech sector cuts as well. We'll keep an eye, see if that is increasing as well. And then obviously into Friday, we have the Bank of Japan coming, and obviously the main numbers coming from the jobs data, NFP, and it's double bubble with the CAD data as well. So a busy old week. What choice parts do you want to take out of that, boys?
Well, it's going to be about the NFP, right? But I think arguably, as I wrote on the chat room, arguably Powell could be a bigger market mover in case he deviates from, the previous FOMC script. So, but yeah, it should be a pretty busy week. I mean, those are the two main events. I don't see anything else really stealing the limelight, let's say.
Yeah. Okay.
Yeah, I mean, the thing is, we've already seen part of the or a speech initial lines, right, from Powell. Well, my base case is that he's not going to deviate from his usual trying to walk the fine line. There could be a little bit of "I told you so" towards the markets in the fact that inflation remains more sticky. But yeah, the emphasis is probably going to lie for those who trade dollars as such, is probably going to lie on Friday. Of course, we are going to keep a close eye on what the other central banks are doing. RBA, Bank of Canada. Bank of Canada is one of those where I think, if my latest analysis is correct, that McClem and friends are getting a little less hawkish, it may be that they spring a bit of a dovish surprise. The issue is the data. The data, apart from a few exceptions, haven't really shown a big setback. But yeah, that one. And then, of course, the last meeting of Sake-san, Kuroda. Is he going to go out with a bang? It's possible that he tries to prepare the terrain a little bit for his successor, putting less stress on his successor. But yeah, the base case is for them to just no change. And we have seen last week's Japanese CPI data coming out weaker than the market expected. Big setback, but still above their targets, right? But yeah, there's a lot of uncertainty going on going into this week. I mean, and then see how what China comes up with, because they can still they are in their 2 sessions this week in full, so there could still be some headlines, whether it be on the monetary fiscal front, but I think perhaps the bigger risk is lying with any geopolitical lines, a bit of a harder stand here or there than they already have shown, even if they politically should not, because they are trying to reopen, should not be too harsh. We have seen that whenever they say something positive, there's a negative line coming right after. So that could be a bit of a mover as well. But I'd say, for me, my base case is that the emphasis of the moves will lie towards the latter part of the week, because I think Powell will walk the fine line again. But of course, every word he says will be dissected.
Yeah, definitely. And as you can see on the screen there, for some of the meetings this week, you can see the rate probability, the expectations for what we're going to get. As you can see there, for the Bank of Canada, it's a 97.3% rating that they remain unchanged. Very small pricing for a 25 pip there. And yeah, Canada's not really seeing the same sort of turnaround in inflation, or it's been on a heading lower, but there's been no real surprises like we got from the US PCE, core PCE, showing a potential bounce there. So they may be happy to stay, as they say, unchanged. Maybe as cases stay on the dovish side, but we've got to expect that maybe we've seen a lot of central banks going into a pause mode, or we're going to pause soon mode, only to have to ramp up hikes again and start talking a bit more hawkish, depending on the data. So we'll have to see what happens there. We could get some neutral or dovish remarks from the Bank of Canada, and then we get a really strong jobs number from them on Friday, and then the coin flips again, and maybe we see some CAD strength coming in to that. So today, I think, starting today, we're all going to be bloody bond traders again, because that's been the main leader today. Bond yields getting well under that 4% mark. You know, we riding up towards 4.10 yesterday on Friday. That didn't last. We came right out of that. We've gone back through the 398. Did that late on Friday, and it's been down ever since. What are you making of this move in yields? You would have thought, given how it looked on last week on Friday, we were perhaps going to start building a base above 4% and looking higher. Now we've gone completely in reverse.
Well, for me, this is my base case. My base scenario is still that we're going to see higher yields. I think this is a correction. You know, we went from 330 something to over 4%, pretty much in a straight line, and you know, a correction is always expected at some point. And also the fact that we have, you know, payrolls this week, and you know, there's always a risk that things might turn. I don't think they will yet. I don't think there's any reason for the Fed to be dovish yet. But there's always going to be retracements, profit taking, you know, everything. And that 4% level is a big level. And you know, I think if I recall correctly, the 1-year rate is at, what is it, 6%, something crazy.
No,
have a look.
5.6%.
5, sorry, 5. No, I said 6. Yeah.
Yeah.
But 5%. You know, I was talking to some friends, and they were saying, you know, 5% for a year in dollars. You know, hedge out your dollar risk. That's not a bad, not a bad return, right? It's starting to get very attractive, and for myself as well. But I mean, for investors. So I think there's always going to be a, you know, a little bit of profit taking of, you know, retracements, but I still think the main direction is still higher for the short term. That's what I think.
Yeah. And you're right. I mean, I've seen some increased talk about this. You know, when you get rates like this, you know, 5%, you do get investors who are happy to go and shift out of some maybe safer assets that they've been sitting in, or even stocks, and move them into bonds, where you can sit on it for a year and get a decent rate, 5%. We haven't seen the sell-off, or we haven't seen yields dropping here like we have in 10 years. So that does reflect perhaps maybe what's going on along the curve. You know, maybe some people thinking, well, even 4% for sitting in bonds for 10 years looks a bit juicy. Obviously, you have to take the inflation side of things as well, because your returns are eroded by that inflation rate. But still, you know, it's some good returns if you start to park your money in bonds, if you're a passive investor and just want to sit in that. So
that's the thing. You have to take a view as an investor on inflation. If you think that inflation is going to be really high, then obviously that doesn't look attractive. But I remember in the late 2000s, you know, 2010, 2011, I was taking, I had an account in HSBC just as a customer, and I was taking these 1 year, effectively 1 year bonds they were doing, and they were giving 2.25%. And I was like, yeah, that's not bad for a year, you know, given that inflation is 0 or close to.
Yeah.
So you have to take a view, you know, and if you think that inflation is going to be at 5, 6, 8, 10%, then obviously this doesn't make sense. But, you know, the 1 year or the 2 year, yeah, it's 5%-ish. It's not bad, you know. It's not bad at all as a, you know, from an investor point of view, not from a, you know, I want to make 50 pips today and, you know, 50 pips tomorrow.
Yeah, exactly. What's your view on that yield move, Kay?
Well, I think Stelios said it pretty accurately there. I think it's a bit of a setback. We haven't seen this. We hadn't seen above 4% in the 10s for a while. So I think, and we've already seen some of the investors saying that they're pretty happy with the returns that they are getting out. Notwithstanding CPI, it's just that if you and we've talked about money going into money market instruments instead of equities, for instance. Although it's not really reflected in equities, I must say. But if you get for longer term investors, if you're coming out of a decade or a decade and a half of zero or 1% or 1.5% interest rates, and you're getting 4%, well, you're tempted to put some money in there, right? So, and I think we are going to see some flows like that coming in the markets. Now going into this week, I think with your lines there, I've got exactly the same around 390, 390, 392, and then where is that the other one? 396 or so, 398, the red one just above.
Yeah, 398. Yeah.
That's the zone. If you're above or below this zone, I think that's going to be your next direction for stuff like dollar yen and those who are really the most how shall I say, the most correlated to those yields. Those are that's going to be decisive for your move. If you end the week below 390, I think it's not a good news. If in turn you're above 4% again, providing Bank of Japan doesn't do anything special, then perhaps your dollar yen is above the recent highs.
Yeah, no, exactly. And I'm just looking at dollar yen now, and overnight we had a little move back towards this low in the 135.40s. Not getting quite as low as that 2030 area that was resistance on the way up, and then became support, but close enough, about 10 pips away over Asia trading. So we are potentially setting up a bit of a range here between there, maybe call it 135 and the 137 and these extension highs. I don't know if we break out of that unless we see a big move in yields. That might be driven by the data. If we get a really strong ADP or weak ADP excessively, so that when we may get a bit of a move. Obviously, if power drops any bombs as well. So if we don't get any big headlines until the NFP, then I'm potentially looking for a 135, 137 range to trade. And then if we do get any bombs, see what happens with those. I'm still short. I got a bit off this morning, 135.58, short off the top here as well, adding to my core position. Again, I'm going to decide whether if I get a move down to sort of 133s, maybe just to get out a lot of the trade or reduce my risk further on the average, because I still think I'm to put it bluntly, pissing into a strong wind with shorts in this one. But the levels are holding for now up here. So while they do, I'm going to try and stay in the trade and see what I can get out of it. Looking at some of the others, bit of sideways action going on in euro dollar particularly. Couldn't quite get down to the 105s. Can't quite get up to the 107s. Again, bit of a range potentially forming here. It's going to take a catalyst to kick us out. So, maybe the money's made trading the edges unless they get taken out. Certainly, it's the same for things like cable. Let's just pop a line because I know a lot of people are watching this. I think they're watching this one. Is it that one? Oh, a bit wonky, but you get the picture. Oh, where are we going? So quite a few people sort of watching that move down there for signs of a breakup. And obviously we've got the 119s down here, 119.20s is the big support that's coming in, protection across that level. So by and large, the trend is still edging downwards, but it's going to be a crunch time soon. I think we're either going to knock out this 119.20s, or we're going to get it back above here and maybe get a run up towards 121. Obviously dollar CAD's in focus as well, and I feel like I've been waiting forever to get a move up to 137 for a potential short. We just keep coming up short in moves like that. If we're trading 136.5 into the BOC, I'm going to be less inclined to look for a trade up here because we know it can be volatile over the central banks. So if they are on the dovish side or less hawkish side, that could well get taken out pretty easily. So despite me waiting quite a while for a potential trade, I'm likely to sit on my hands if we're that close to it over the BOC. But otherwise, it's got a pretty decent range up towards the 136s and a half, 137s, down towards the mid to low 132s, and it's happy to walk in between those levels for now. Again, it's going to need some sort of catalyst, I think, to break us out of there. So until then, trade the levels, trade the ranges. Aussie dollar, something's going to happen here soon. I think, this range is really pretty tight. We haven't seen that tighter range for this length of time really for, quite some time. So obviously the RBA coming up, and that's going to, again, maybe be the catalyst for a move. But either we're going to get above this old fib 67, 70, 80 and the 68 handle, or we're going below 67. I can't see us staying in this range for too long this week. So it could be a case of going with a move either side if we start a breakout. The problem is it's not far until the next level. So if you break down below 67, we've got this band here, the 50 fib down at 66.60s, bit of a former support and resistance area, as you can see there. So that's the next band of support we have to get through if we have a break and want to push lower. As I say, conversely on the upside, it's got to get above 67.80, 68, and then we run into trouble again if we get into the high 68s. So it could be a case we see some breaks, but we're not looking for rockets or any big rug pulls going on. It's going to be just moving up to the next areas to keep an eye on. But you can still got some pips if you go for a break trade up here, and we do get a shift on up there. Euro sterling, after this move down here, we're going to move back up towards 89. Now we're middling a bit. We did come off on Thursday, Friday, after the moves up to these highs again. But now it looks like we're going sideways again. I don't see any reason why this breaks out either side for now. I think the risk is for the Bank of England to be a bit more hawkish, so there could be further downside. But we know the ECB's on a hawkish path. And if they signal that maybe we're still going 50s after the March hike, that may put a bid under this one again, and maybe we get a run up towards 90s on that. As Kay mentioned, dollar China looking a bit perkier now after that move sub 691.92. Still, I'm a bit neutral. I'm either going to play it up here near 7, or I want to move back down here to the 77, 78s, 80 area for looking at a potential trade. See if this zone holds once again for the potential for longs, and then just see to play the range in here. Even with this news, this session that's going on in China, the upbeat data that's come out, we're not making, okay, it's a big enough move, but we're not doing the sort of thing that we saw some time ago where we had, a pretty big move coming into 2022 and a big move down. So we are middling a bit around here. So it could be a case again of just playing the ranges between the decent support and the decent resistance, see what happens outside of that. Anything tickling your fancy this early on a Monday, Kay? I was keeping half an eye on dollar MEX. It broke that 18 level, but it's finding it resistance at the moment. It's a bit similar to what happened up here at the 1850s, where we had the break and then it confirmed it, and now we're down here. And do you think there's more downside for this one, or?
Yeah, I mean, for the time being, I'm still of the impression that don't change a winning teammate. I know people are trying to find bottoms in there, but you need courage to go against this move. Of course, it's not going to go in a straight line, and of course, if one tries to find bottoms here and there, they will hit a sweet one sooner or later, and we see a rebound. But are we really ready for a rebound? I don't know. If you look at the US yields and yields across the field coming back a little bit, it's still that's still another fact that should support the MEX as well. And there's still like these articles coming around. I saw one, and that was from last Friday or so, and then referring even back to articles from earlier this year, is that even China is investing in Mexico, because we know that the US has shifted some of its manufacturing from China into Mexico over the pandemic, over geopolitical pressure. And the mix now still even sees investments from China directly, who have understood that if they produce in Mexico, they are closer to the US to export from there. So it's all like still playing in the hands of the Mexican peso, and it's an 11% currency. So there's still no going around that. And so yeah, I mean, if you see a setback in risk, you can see a rebound. You can see a technical rebound as well, because there's a bit going on just below 18. But as I've said, like once we've broken below this $18.15 mix, there was very little to hold it from going lower, and we have done another 3% in the meantime. So yeah, I mean, of course, I mean those who are playing long-term carry trades, they're getting the double benefit now. So you can't rule out that some of the funds or whatever they need to adjust their positions at some stage, because they are going to hit profit targets and things. But and it's not only dollar mix, you know. If you look at all the mix process, you look at mix yen, you look at euro mix, the bounces are very shallow. So for the time being, I think if dollar mix starts to go back above, I've got something around, where is it? And you can stay.
Do you want to grab it and show it, mate?
You can stay on yours.
Yeah.
It's around 18. I've got it around 18.20. If we bounce above there, then I think we are going to have a chance to revisit 18.50. But now I think 18.50 is already going to be a tough nut to crack.
Yeah, so, it looks like 2030's a couple of points there.
Yeah, and there's a bit of a line as well coming in from 2017, a longer term one, and I was pointed to that last week by somebody else. But it's a fine touch somewhere, but that comes in around 18.20 today. So, but yeah, I think it's still a situation where the mix is getting inflows, and who are we to fight that, you know?
Yeah. So what would I mean? You know, it's been a big run down. You know, if you're playing this just from a carry point of view, do you ignore the profit you've made in the position itself for the carry?
Well, I mean, you're not going to ignore it because it's making you actually as much, if not more, than just sitting in the carry. But no, you probably let it go. That's the thing of the carry. Now, and you're probably looking at possibly bringing your stop losses down, so that your for instance, I think those who are reading in carry now, if you do it in dollar mix, they will probably be sitting above 18.50. That would be the logic one. If 18.50s goes, that means that we can see a bit of a turnaround, because that will already be 3% of the lows. But those who are sitting in carries, they probably have made much more. If you do it in stuff like euro mix, for instance, you'd be looking at well, if you want to take it tight and it's like a position, then above 1930, 1945, you're probably going to start to unwind a bit. But if you're really long-term players, you're not going to move anything before this thing goes back above 20.
Yeah, exactly.
Because the carry trade, you benefit. The carry trade somewhere, you actually take into account that you could lose a little bit on the actual position, but going to make a lot more on what you get in interest rates. So but now they are in a double positive scenario. So I reckon some people will look at some levels though.
Yeah, I think that's possibly why we're seeing, such great price action, on the big levels. This 18 was a big level on the way down, and here we are, broken it, and we're holding it as resistance now. So, there's players, like you say, probably shifted down, want to hold this level now, because if you're short up here and you can hold it here, then you're going to get a move even further down to the next level. So, interesting one to keep an eye on. Yes, anything else you want to have a look at, Kay? I know Dimitri's having a look at CAD yen, and you got that one on your radar. Hello, Kay. Hello.
Sorry, mate, I was on mute. Do you want me to grab the screen?
Yeah, go on if you want to grab it.
Right, CAD yen. We're seeing this channel or whatever, and it was one before, and it starts to show up again. I was wondering whether it would show up, but it does look like the market is trading around. We also have this prior little zone here, 101.20. Whoops, 101.20, 99 and a quarter. And it looks like we are back playing there as well. So that is likely going to be a bit of a zone of interest. I'm like, I don't know what to do with it. So I mean, for me, I look at takes probably after I've made up my mind whether my bias is going to be long or shorting something, and then I see if one of the pictures is giving me an entry for what I want to do. So perhaps we can have a look at it a bit like this as well, a bit of a triangle. So going into this week with Bank of Canada and Bank of Japan, you're going to look at 101, the 99 and a quarter, as I said, and then here there's going to be 98. Well, it's not too far, 98 and a half, 98.70, but by Friday this is going to be closer to this is going to be over 99. So this 99 and a quarter, 99 zone is going to be of some importance, I think, going into this week. But we can have big moves on three fronts. Actually, you can have those moves because I think we have as well rollovers in the oil contracts, which could drag the currencies which are looking at oil a bit around as well. Then you have the Bank of Canada, and then you have the Bank of Japan. So and each of them perhaps less oil these days, because Canada seems to have decoupled a little bit of its strongest correlations. So, but we have Bank of Canada and Bank of Japan, and both have the potential to take this thing out of the ranges. So keep a close eye on those levels. If you start to get back above 101 and a half, then I think we are back to 104 potentially. If you break below this 99 and then you confirm under 98.40, then you can have another 3 big figures to the downside. So, and this week has the potential to make this one move. So yeah, it's going to be an interesting watch. I'm going to keep an eye on it as well. The other one is EuroCAD. I've been talking about this 144.5 level, and really, if you look at it, it's been playing a role every time we are going above, below. So it's seen like an accelerator or a hold or a cap, or and now we are trading a little bit above. Looking at the how divergent in opinion and in comments at least ECB and Bank of Canada are, if the data don't go against those comments, I don't know. I was a bear on this for a very long time, and I'm slowly shifting my view. Last week I had a bit of a long, went out of it at decent levels, then watched it go down. Didn't buy it back because I didn't know what was going on, and then oil was going up again. But it looks like the euro on several crosses, by the way. The euro still has, I call it elasticity, which is finding easier bids than a currency that would be weaker. So it's showing a little bit stronger on the crosses, the euro, and you find it back on the euro commodities, find it back on this euro CAD, and you find it even on this euro yen. Euro yen is holding levels, and since end of February, when we started to move higher, we haven't had a retest of the big support zone, and this one as well. I'm going to keep a very close eye on going into the Bank of Japan as well, especially as well with the CPI coming back off last week. This could be an interesting one, providing European data are sort of holding on up. Sorry. Another one where I don't know. It's still, if you look at the picture, it's still looking like a negative picture. But I'm also finding sterling starting to find a bit easier, although this morning isn't really showing it. I thought the picking up of UK, US potential talks would have been a bit positive sterling, but the market is not trading it at all. So I've just had a really quick stab, and but since the market isn't trading it, I'm out of it. Yeah, so watch 120.40 confirmation above 120.55 should take this back to 121.40. But if it doesn't work, back to 119.70.85, I'd say, and then if the dollar picks up more strength, which I'm a little surprised that the dollar is so strong this morning with those yields coming back down. But yeah, if the dollar still keeps its, or if Powell says something positive, really positive for the dollar, then we are back into retesting 119.16 and 119 the figure. I've got another level there. So those are the levels that I'm watching going into this week on the cable. Anyone want to talk about anything else? Because I'm a little I don't
bit
think really much running at the start of this week. Sorry, Ryan?
You were a little bit Monday.
Yeah, I mean, a quick look at gold for the shorter term, 1865. Yeah, and I know there's a bit of FIPS going above one each other, but it's 1865 is the 50% of this move lower. So that's one to watch. And as I said, this 42, 48, and then 41 zone should come in as a bit of support. If not, then it's likely back to the prior lows. Silver started to reload just tinies. Still not clear, and perhaps for those who want to be long silver, perhaps those China 2 sessions are not giving us too much food either. Would have been funkier for this one for China to go like all guns blazing on reopening and stimulus and stuff, and I think that would be like a case for silver to really take off and re-challenge those 22 levels, but we're not getting it right now. WAP, here we go. DE30, is that DE40? Those in these days, Richard? You're talking about the German, right?
GER 30, the DAX.
Yeah, but it's 40 now, no? Those days.
Yeah, Richard, they've chucked 10 more in.
Well, I mean, that's a bit of a, how do you call that? Stealth pennant, whatever, flag?
Is it a megaphone? I don't know.
I don't know either.
Dale will know. We'll have to ask Dale. What pattern's that one?
I have no clue.
Okay, let me put it a bit more longer term. This is bid, right? And I see a fundamental reason, which is the same one that we had in January, which is ECB is pretty hawkish. The European data, comparably to others, are not really falling out of bed. The euro crosses are beat, and I think that may be one trade. People are moving probably back a bit again into Europe, and they haven't given up by the looks of things. Yeah, there's a bit of a level actually. This is a bit of a zone, right? 15,600, and then you're talking about 15,750. You really need to get back under. If we break back under here, here, here. Okay, this is it. I think this is your support zone: 15,205, 15,100, 100 and a quarter. You have to get back down there to get a chance to see this one a little bit lower. If we break under 14,900, 900 and a quarter, it's end of chat in my opinion, and then we go lower. Look, coming back nicely from earlier as well. So that's your playground, I think, on the DAX. If I look at it, so we're on a level here. Then you have 15,750, and if that goes, who is going to hold it back to get back to this double top here? So that for the DAX. I was also looking at Jesus. I mean, why am I never on the right one? What's wrong with TradingView these days, guys? Because I can hardly keep a chart up to date. It always brings me back. Look, I mean, it's gone again. Always brings me back to prior saved stuff.
Is it not the one in your watch list?
Where I should. No. Yeah, thanks, Ryan. Yeah, here we go. Okay, I've quickly updated it. Okay, so yeah, this is absolutely not the one that I was looking at. Here we go. Right, we have this this big zone, and Blake also talked about it on the weekend video. So if you guys care to have a look at it, Blake was talking exactly about these low 39s in the S&P, and then there's this one, which is the latest. We also respected it here and here and here, and that comes in around 4017. So the 4,000, 4,005, 4,015, that's going to be the first support again, I think, here. But I wanted to quickly touch upon it because I think it's very interesting that it holds up well despite those higher yields that we've seen across the board. And I think there's still people. This is still a result of the soft or no landing trading, in my opinion. And now with yields coming back off, this is seen. But I do find them really well supported still. So and of course, since the pandemic, there's still a lot more liquidity in the market. But there's also people looking at, as we talked about that, on putting their money in the 1 year, up to the 2 year, up to the 3 year probably, which are around 5% or just below. So to me, that should mean a bit less money invested in equities because it's riskier in equities. And yet they are holding up really, really well. So we are going to have to find a catalyzer for those who are bearish stocks, we're gonna have to find a real catalyzer to take it lower. We have seen the move above 4%. Had put it a bit lower, but it was only we only needed a little bit of setback, and we are already back to levels where we were well before the when the rates were on the way up. So stocks are still holding in very well, in my opinion. So I'm not planning to go really short until we really break below 3,900. I'm going to do this as a momentum trade if I do anything in this. I wouldn't be surprised if we trade if we retest 41s, to be honest. And that's really it for now. Mexican peso, don't change a winning team. We are trading at the lows. We are getting only very, very shallow rebounds. We are trading at those in back to levels not seen since 2016. But who is selling an 11% currency is my question. And with that, back to you, Ryan.
Thank you very much, mate. Good stuff as always. So yeah, we have got a busy week this week. Lots of events going on. The thing to remember is don't look at everything like a lottery trade. You know, all these big events could be big market movers, but what you have to keep in mind is how do they finish up? You know, are they going to break levels that we've been watching for a long while? And that's the way you've got to judge these moves. You know, if Powell comes out with something hawkish, don't think dollar yen's going to 139 in a straight line. Don't think yields are going at 4.5% in a straight line. You've got to look at what the price action tells you. If we get strong comments, the likes from Powell or good data, we've set some markers in things like yields, 4.09, 4.10. We've set a marker in things like dollar yen, 137, 0015. Downside 135, 2030. So when you've got these markers, if there's big news, it has to break those levels. If it doesn't break those levels, it tells you the market is happy with what it's getting. So don't get sucked into the thinking that every big event is going to mean 3, 4, 500 pip moves everywhere. Let the market do its thing. Watch what the market wants to do. If it wants to move, it's going to move. If it does move, can it hold that move? If it breaks levels, will it hold that break or will it fail, just like the yields situation did in 10 years? So go through each event, however you trade it, match it off against the longer term expectations for what the market wants to see moving forward. Is it changing those or is it not? And then you keep your expectations in check and you don't get caught in a trade thinking that a break is going to run 500 pips and it ends up reversing on you. And it's a fake out. So trade safe. That's my biggest piece of advice this week. Make some money as well. Lots of pips, please. I want to hear all about your trades coming in. And we shall pick this up again tomorrow. Thank you, Kay. Thank you, Stel. Thank you all for coming to the Flow Show.
Thank you both. And everybody have a good day.
Have a great week.
Cheers, guys.